Lloyd, Mark, Naved, welcome. A couple of you are veterans to the stage. Naved, first time. So we're glad to have you.
Great to be here.
So Wall Street's been quite roller coastery, shall we say? And travel obviously has been no exception. We saw Q3 results were very strong at all the travel companies, Expedia, Booking, TripAdvisor, Airbnb. And the companies are also pretty bullish when it comes to, future expectations, demand is really strong. Give me your take on what we are seeing here. Lloyd, let's start with you.
Yeah, like you said, the quarterly results were good. The commentary about early 4Q, everything is holding up quite well in the accommodation space, which is the big money maker for the OTAs. I think the outlook, though, is obviously very uncertain. There's a lot of concern in the investment community, particularly around what happens in Europe as we go into 2023. We're in this phase where we're moving from, to some extent, from recovery stories to questions around what does normalized growth look like, and then compounding that is, what happens to travel in a recession. So there's a lot of nervousness in the market as a whole, and then, of course, technology in particular and travel as well. So there's a lot of fear out there, but so far, trends are holding up quite well.
Mark, you agree? Some of that fear being reflected sort of in the movement of the stocks that we've seen just this year?
I agree with Lloyd. This is the exception, this room in this conference. Everything else in the economy is slowing down. When Google search and cloud computing slow down, chances are everything else is slowing down. The only part of consumer spend, consumer discretionary spend, that's holding up is travel. And I hope it continues to hold up. You look at the growth rates in the back half of the year, they are very consistent. There's even a little bit of acceleration. There was so much pent-up travel demand by businesses, business travelers, and by leisure travelers. So that's really the big explanation here. Question is that continue as you go into 23 and as the job cuts come. And that's not just Facebook that cut off, or Meta that laid off 10% of its workforce. There's a half a dozen companies that I look at that have had 10% workforce reductions. And my fear is that we're going to see more of that. Amazon announced some cuts, and I would think the first thing that happens, I've gone through it, when you get laid off, you cut off those vacation plans. So I do worry about that. I think the shoe's going to fall on travel, and I think that's sort of been a little bit of a headwind to these companies. But their fundamentals have been extraordinarily impressive year to date. And what I really look for is what's the growth rate, like Lloyd was talking about, what's the growth rate when things normalize? So as we move beyond COVID, and one of my son's schools just got shut down again, when we move beyond COVID and then when economic conditions normalize. And I hope that that's in the back half of 23. And I think you've got some really good assets in here, Airbnb and Booking and Expedia, to list three that have. The one big advantage is that they were the first hit by the COVID crisis, so they had to take down their cost structures dramatically. They had their dramatic RIFs at the beginning of COVID. That meant that when the demand recovery came, these were lean and mean businesses, unlike some of the other companies that had big demand surges, way overhired and overbuilt, and now they got to go through the painful part of letting people go. So I like this sector. I think there's going to be an overhang until we get that demand correction sometime next year, and then that could be a great opportunity with these stocks.
So, yeah, Naved.
Yeah, no, I just want to say that, so this was supposed to be the year of the big recovery in travel, right? So what happened, if you look at the stocks, they already peaked, right? So look at Expedia, I think 200 plus somewhere earlier this year, and look at Booking, same thing. So I think as we have gotten deeper into the year and people start looking at 2023, the question we as analysts keep getting asked is, what do you think growth looks like in 23, right? With everything that's going on at the macro level, whether it's the Fed raising rates or, whether it's the consumer pent-up demand sort of waning. Right? So I think that's exactly how investors are thinking about it, and that's kind of reflected in the stocks today.
But how long do you think, Mark, you made the point about sort of pent-up demand holding up the market as well. isn't it that ADRs have been really driving margins? And what happens if we start seeing some pressure on ADRs as inflation starts to buy these continued cost rises that we are seeing in the price of travel? What are you expecting there when we start seeing pressure on ADRs, perhaps, as kind of the economic kind of macroeconomic pressures start to play out?
Well, I think there are parts of this world where people are cutting back on food and milk in order to travel. I mean, I think that's sort of what, unfortunately, I'm joking just a little bit. So, this is generationally high inflation. I mean, we all are living this. It's highly regressive, by the way, but it's generationally high inflation, and so people are cutting back. Consumer discretionary is getting weak. It's just that travel has yet to fall into that, but we all know that travel is in that consumer discretionary bucket. It just was so pent up. Anyway, I would think that you'll start seeing that cloud. I do think inflation starts to moderate. I think that's a wonderful thing. I think that is going to start crimping travel spend next year, and I particularly focus on the impact of the job layoffs on that. I think they're going to be rising. And then ADRs, that's a real key variable for these companies. And we've had a dramatic surge in ADRs. I think something like up 25% or something. And I know Air DNA has good data on this, but 25% in the last 2 years, it's really high. But my guess is that these ADRs probably hold, maybe come down mid-single-digit percent. I don't think there's any dramatic correction likely in ADRs. I may be completely wrong, but that's my hope, and I think that's my belief.
Lloyd?
Yeah, I think we're modeling 2 or 3% ADR pressure next year after this enormous gain. I think it's been most pronounced in the metrics at Airbnb, where you've seen ADRs almost double over the last 2 years. Now some of that is just a mix shift issue where people are, the U.S. is holding up better. U.S. has much higher ADRs. People are traveling to whole homes instead of apartments in cities. So there's a little bit of just mix shift in that, but it's interesting. They have been telling investors for the last 3 or 4 quarters, we don't expect this level of ADR to hold. We think it's going to start to normalize, but they've started to communicate the view that they're actually stickier than they thought. And I think to some extent we're going from a world where everyone was traveling to the same places during the pandemic. South Florida was booming, ADRs expanded. I think you're now getting to the point where the broader inflation is rising prices in every market, to some extent, regardless of demand, which is probably stickier. So it's definitely a focus in the investment community because it is so profitable. When price goes up, that all just drops to the profit line. And so if that reverses, it could be painful, but I think Mark's right. I think there's probably some modest weakness, but I don't think we're going back to where we were in 2019 on prices.
Okay. And so if there is a wider macroeconomic downturn, who do you think is best positioned among the OTAs or the larger travel companies to weather it? Naved?
I want to say depends on the use case. So if you look at Airbnb's model and if you look at large groups, maybe 5, 6 people, maybe 10 people traveling someplace, it might be still more cost effective to rent that home versus staying at a hotel. So I think in those kind of situations, home sharing lends itself very well. If you look at individual travelers or people traveling as maybe singles or maybe just a small unit, people might have better choice when they look at hotels. They may not stay at that 5-star hotel. They might trade down. They may not stay 5 or 7 nights. They might stay 3 or 4 nights. So I think the two models kind of cater to different use cases, and they both have their strengths in terms of what they can offer, depending on the use case.
Okay, you guys agree?
Look, our preferred name in the space right now is Booking.com. I think they would be pretty well positioned in a downturn. They've got a strong balance sheet. They've got a large buyback authorization, history of discipline and disciplined capital return. the risk would be for them is if Europe really takes the hit. They have about 50% of their bookings are coming from Europe, so they have a lot of exposure there. There's a lot of concern in the investment community around Europe, even talking to the players in the space like Trivago, which is based in Germany. They're worried about what's going on over there. Energy prices are soaring over there. In certain markets in Europe, you pay for energy at the beginning of the year. You prepay for your energy in Germany, and at the end of the year, you have a catch-up. If the prices went up, you have to pay more, and so you're going to have consumers in Germany paying for last year's prices and prepaying for next year at a higher rate. There's concern there could be a shock around that event. So I think it will depend on where the weakness happens, but I think they've all kind of learned a lot from the slowdown in the pandemic. They're in better shape now with balance sheets, and I don't think we're going to see anything like that, certainly.
Okay. Well, let's turn to marketing strategies also, because we've seen some divergence between the large OTAs, right? Expedia's said it's focusing less on discounting. Booking is focusing on merchandising more. Everybody has said for many years now that they're not going to spend as much on performance marketing. So give me your thoughts, Mark, on where you think this is going in terms of sort of this divergence, because it used to be all Google, didn't it?
Everybody says they're spending less on performance marketing, and that's probably true, but I just kind of wonder sometimes. The one company that clearly is Airbnb, and they were slim fast when it came to performance marketing prior to COVID, and because of COVID, they went ultra slim fast. I hope that analogy works with people. I mean, the amount of money that they spend on performance marketing is so limited, but then they're a verb, they're a noun, so they have that's a huge advantage for them. The trend is that Expedia and Booking are getting more and more traffic to come directly to their site. That's fundamentally great for their business models, because you can get the single biggest cost item for these companies is marketing. So if they can continue to do that, that's great. I think I recall Booking announcing 4 or 5 years ago, that they would finally reach over 50% of their traffic is direct. And they keep repeating that number, and it's a little over 50%. Like, that ship is just taking a long time to turn. And I think for some of these companies, it's a very hard thing to turn, because consumers they're very used to going to Google to figure out where and how to fly places. So I'm sure that performance marketing is going to fade, but I think it's going to be a very slow fade, especially for Booking and Expedia. I imagine that they have been historically two of Google's biggest direct customers. I bet you they were top 5. And if they're not top 5 today, I'm sure those two are at least top 10. And I don't think that changes dramatically anytime soon.
Lloyd?
Yeah, I think Mark's right on this one. I think they talk about spending more on brand and getting more traffic direct, and I think they are doing that, but the actions are slightly different than the words in some cases. They are still spending heavily on performance advertising. And look, I mean, everyone in this room probably knows consumers have been trained to shop around for deals in travel, because hotels price differently in different channels to try to maximize revenue, which creates these discrepancies that consumers have been trained to find. And so it's hard to put that genie back in that bottle. And so I don't think that the world is going to change. Expedia is talking about finding users through paid app install ads and brand ads, as though there's some magical users out there that are going to be super loyal to Expedia. We've been highly skeptical that it's quite as easy as they're making it out to be. Now, what's interesting, you're also seeing a shift at Booking where they're using more merchandising. They're able to price lower in certain circumstances. They're giving credits to people when they book direct, which is, I think it's a great strategy, because you're basically incentivizing the repeat behavior and the repeat direct by giving these small credits. It's a new muscle for them, and you're talking about the best performance advertising business probably on the planet now has a new tool. So yeah, if you look at the aggregate marketing spend plus the merchandising spend, it's a big number relative to kind of what they were spending in 19, but it makes a lot of sense. And whereas Expedia's talk of brand spend and app install is much less convincing to us. And of course, Expedia is about to add loyalty to Vrbo, which is very expensive. I mean, that is a unit economic killer if it's not done really well. And I think we're going into this period where there's going to be a take rate drag from that, and we're not going to know if it's going to work. So we're in the skeptical camp on that strategy.
So do I have this right? You're saying that booking sort of point of sale incentive, the small discounts, those work better as a loyalty driver than perhaps the way that Expedia envisions it, which is, if I can say, a traditional loyalty program. Right?
I don't know that one is necessarily better than the other. I think the loyalty program may well be more effective at driving repeat and direct, but it's extremely expensive to do that. And it's, in my mind, sort of a blunt instrument. We'll see how they structure the plans. They're smart guys. They can come up with a way to reduce the expense of it. But you look at a program like the Genius program, where the accommodation providers are providing most of the incentives in that loyalty program. It's a very smart way of doing it, a way of reducing the cost to them. And then I think layering in merchandising makes perfect sense as a new tool in their toolkit.
Naved, do you agree on paid app installs kind of being expensive and just the merchandising point of sale being a better strategy, I guess, than loyalty overall, a loyalty program?
Yeah, look, I think it's part of the equation because ultimately it depends on which tool is more effective at acquiring the customer. So they're all trying different strategies and seeing how the consumer responds, and not all consumers will respond in the same way to that merchandising deal that's being offered. So that's one. The other thing I want to come to is maybe back to the original question you had about performance advertising and how the OTAs are kind of changing that. Maybe I want to say I agree with Mark on there's maybe some extent to which that can happen, but it's probably going to be very gradual. And if you listen to Google's commentary, they've been highlighting travel as one of the strong growers in recent quarters as well, which means that the big spenders, i.e. the OTAs, have likely come back by and large. Whether that spend can be tweaked, I think there's always opportunity, and that's probably happening, but to what extent is hard to say.
Okay, and going back to Google, Mark, I want to ask you a follow-up question to something you said in 2019 about the Google squeeze being, not going away, I think is what you said, to paraphrase at that point. You still stand by that?
Boy, I'd forgotten that.
Well, that's why we're here to remind you.
Well, I tell you, we do a lot of survey work at my firm, Evercore ISI. We also do survey work of young people, people a little younger than me, but we do it of teens and young adults. We actually found a spike in usage of Google Travel amongst teens and young adults. I wonder whose credit card those teens are using. But anyway, and it's just a one-time spike, so that's not a trend. But Google Travel has always been out there as a little bit of an issue for the OTA. So squeeze, I don't know, but maybe that was overstating for dramatic effects years ago. But I think the point, I don't think performance marketing, and there's another word for that, Google, I don't think that's going away at all for the travel industry anytime soon. And I think it's really powerful too. I don't mean to say in such a bad way. I mean, Google is consumers love Google. And why shouldn't they? And Google's done a wonderful job at helping consumers get to what they want in terms of the travel services and offerings. So it's unless you're Airbnb, it's kind of Google's world. You just got to figure out a really efficient way to play in it. And these companies have figured out a way to do that. So congrats to them.
Okay, I want to talk about sustainability. Because obviously, the entire travel industry is talking about sustainability and what it can do. We have found in our research that travelers are more conscious when they're making decisions. We didn't hear a lot, at least during the last results, about sustainability from, Booking Holdings or Expedia, Google, TripAdvisor. So they're all part of, obviously, the Travelist coalition. Is there anything that you've seen from these large travel companies that kind of, talking about sustainability initiatives that you think could drive shareholder value or that could be attractive for investors? And, just as a follow-up to that, what do you think really about all the talk of sustainability? Is that a value driver for the travel industry from where you sit? Okay, I like that when it's like a tough question that nobody wants to take.
So,
Naved, please.
I'll take a stab at this. So, part of what I guess most companies are trying to do is trying to be good corporate citizens. And I think sustainability is going to get more and more important as we look further out, because obviously the world is getting warmer, and therefore more people will care. So if you look at just the OTAs and what they are doing, I think they're doing it at maybe two different levels. One is as a corporation themselves, right? What is their footprint? Are they carbon neutral, or can they get there, right? And the second thing is, what do they put in terms of tools that they can show to the traveler when they make the booking, whether it's a hotel or whether it's for a flight, right? So if you take a flight from New York to Miami, what's your carbon footprint like? So I think ultimately it'll come down to the consumer, and the more the awareness, the more people will make that decision accordingly. But I think as we go further out, you show people the tools, and I think it'll have to be that level of awareness that drives that decision at the consumer level.
So you think the push is going to come from the consumers, where they're making those decisions whether to book with Booking.com or Priceline or Expedia, and what they see there in terms of their own values, if I can call it that.
So it has to come from all the stakeholders, right? So if you're a Marriott and you are able to surface that information for all your properties, which one conserves water, or if it's a flight, then comes from the airlines. I think all the stakeholders have to participate, and right now what's happening is getting that information out to the consumer, and finally it's the level of awareness at the consumer level, which I think which
still a little bit away. It's not happening, next quarter or next year.
But it's a rising interest for consumers. I live in the San Francisco Bay Area. I drive my Prius to the BART station, which is the subway station, and I feel guilty about that, driving the Prius. There are groups of consumers that really care deeply about this, and I think these companies have sort of responded to that, maybe a little belatedly. There's a lot of carbon emissions associated with this industry. Anyway, so to Naved's point is that consumers are going to lead companies to be much more focused on sustainability. I'm not sure investors will, but consumers will.
Okay, great. Let's talk about something fun. Meme stocks. What does it take for a travel company to become a meme stock?
You don't want to be a meme stock.
Yeah, hopefully those days are fading.
They do seem to be behind us. I mean, there was a time
an executive
when
with a cult of personality, maybe.
I want to say you don't want to be a meme stock, but if I had to look at the characteristics of meme stocks, right? So there are two that stand out. One is a higher level of short interest from people, which means your stock is heavily shorted. The other is you have wide following in the social media, maybe a Reddit group, people that can drive the stock. So, but would that guarantee that you become a meme stock? I don't know.
Well, like Mark said, nobody wants to become a meme stock. Certainly we don't want it in this industry. Thank you very much, Naved, Mark, Lloyd. Ladies and gentlemen, our panel here.
Thank you.
All right, thank you.